It's not really about how much you earn that determines how quickly your money grows. What matters is how many doublings you capture and how many you actually hold on to. The rule of 72 and the rule of 114 let you work out those doublings and triplings in about 3 seconds of mental math. But both shortcuts assume you drop in one lump sum and never touch it again. Real people don't invest that way. They add money every payday. So here's what we're covering, what these two rules actually tell you. What shifts once you start investing monthly, whether daily or weekly beats a monthly deposit, what taxes genuinely take from you, and 3 moves that protect your money going forward. Let's start with the 2 rules themselves. Take 72 and divide it by your annual return, and the result tells you how many years it takes for your money to double. At an 8% return, which is a fairly realistic long-term average for a diversified stock portfolio, that comes out to 9 years. The rule of 114 does the same job, but for tripling your money. Before running the numbers, try a quick mental test. If doubling takes 9 years, how long do you think tripling should take? Most people guess 18, simply doubling the time for triple the money. Hold on to that guess because it becomes important later and reveals something a lot of investors misunderstand. The actual answer is 114 divided by 8, which comes out to just over 14 years. Watch how both rules play out on the same $10,000 investment. It becomes $20,000 after 9 years, then reaches $30,000 roughly 5 years after that. Notice that the second $10,000 in growth showed up faster than the first because there was now twice as much capital generating returns. That's the core mechanic behind compounding, and it keeps speeding up over time. There's even a rule of 144 for quadrupling your money, which is essentially 2 doublings stacked back to back. But all of these answers assume your original $10,000 just sat there untouched for decades. Almost nobody actually invests this way, so here's where things get more realistic. Let's look at what happens when you invest the way real people do, contributing a little from every paycheck. Say you're putting in $400 every month at that same 8% return. To make the numbers easier to relate to, that's roughly 8% of a $60,000 salary. Here's how the balance grows year by year. After 10 years, you're around $73,000. After 15 years, $138,000. After 20 years, $236,000. After 25 years, $380,000. And after 30 years, $596,000. That growth scales in a straight line, meaning every additional $100 a month adds roughly $149,000 by the 30-year mark. Where do these figures come from? A single formula repeated over and over. Take your 8% annual return and divide it across 12 months, so your balance grows by about 0.67% each month. Then a fresh $400 gets added on top. Repeat that process for every single month, and across 30 years, that's 360 repetitions. After those 360 months, you land at $596,000. Plug the same numbers into any free compound interest calculator, and everything here checks out. Now here's the part that catches people off guard. If you track this account closely, it crosses $50,000 in year 8, then hits $100,000 by year 13. That's a doubling in about 5 years inside an account where the rule of 72 predicted 9. Tripling shows the same pattern. The balance jumps from $100,000 to $300,000 in roughly 10 years, even though the rule of 114 said it should take 14. Every doubling and every tripling arrives earlier than expected, because your ongoing contributions keep pushing the balance forward, while compounding does its work in the background. So it helps to reframe how you think about these 2 rules. They're not really your target, they're your worst-case scenario, the slowest pace your money will ever grow as long as you keep contributing. That's exactly why a modest balance in year 5 isn't something to worry about. Those early years are actually the fastest doubling period you'll ever experience. And people who give up at that stage just end up resetting their own progress back to 0. Here's one extra tool if you want to calculate your own numbers. There's no perfectly clean formula for doubling time while you're actively contributing, but there's a solid shortcut. Add your annual return to your yearly contributions expressed as a percentage of your current balance. Then divide 72 by that combined number, or 114 if you're calculating for tripling. Let's say you already have $100,000 saved, and you're adding $4,800 a year at an 8% return. That's 8 plus 4.8, which comes to about 13. Dividing 72 by 13 puts your next doubling roughly 5.5 years away. This shortcut works best when that combined figure stays under about 15. In the earlier years, when your contributions are much larger relative to your balance, the estimate tends to run a bit optimistic. But at that stage, you barely need the formula anyway, since your contributions alone are driving most of the doubling. Now, does it actually matter how often you invest? Take that same $4,800 annual contribution and split it 3 different ways: $13.15 daily, $92.31 weekly, or $400 monthly. Run each scenario for 30 years at 8% return. Daily contributions finish at $600,172. Monthly contributions land at $596,144. So, investing every single day for 30 years only beats a monthly schedule by around $5,000 on a $600,000 balance. Less than 1% difference, essentially negligible. What actually hurts your returns is delaying your contributions. If you hold onto your cash all year and invest it as one lump sum in December, you end up with roughly $543,000, about $52,000 less, simply because that money spent months sitting idle before it started working for you. So the frequency of investing is really a minor detail. The bigger takeaway here comes down to a single moment on your investing timeline. In your very first year, you contribute $4,800 while the market only adds about $180. At this stage, nearly all your progress comes from you personally. Around year 10, that balance flips permanently. From that point on, the market starts contributing more to your account each year than you do yourself. This turning point is called the crossover point, and it's the entire reason surviving those early years matters so much. By year 30, the market is adding $45,486 annually, 9 times more than your own contribution. At that stage, you're essentially just along for the ride. The money is doing the heavy lifting. One important caveat: the market never delivers a steady 8% every single year. It climbed roughly 25% in 2024 and dropped about 37% in 2008. So your personal crossover point might arrive a bit earlier or later, depending on market conditions. The takeaway here is simple: invest according to whatever schedule matches your paycheck, automate the process, and stop overthinking the calendar. Now here's something most people don't factor into their planning. Both of these rules only apply to the return you actually keep after taxes are taken out. Suppose you're earning 8%, but your gains get taxed annually at 22%, which is how the IRS treats interest from savings accounts and short-term trading profits. That means the government takes 22 cents from every dollar your money earns, leaving you with 78 cents. And 78% of an 8% return works out to about 6.24%, which becomes your actual after-tax growth rate. Apply both rules using that adjusted number. 72 divided by 6.24 means doubling now takes about 11.5 years instead of 9. And 114 divided by 6.24 means tripling takes roughly 18 years instead of 14. Remember that earlier guess where 18 years felt like the natural answer for tripling, but the real answer was actually 14? Once you tax the account every year, your original instinct turns out to be exactly right. The IRS effectively slows your money down to the pace you originally assumed it would move at, and taxes aren't even the largest drag on your returns. Inflation also erodes your purchasing power on top of this, though we're setting that aside for now to stay focused on taxes specifically. Zooming out to look at an entire career, imagine investing $100,000 at age 29 and retiring at 65, giving you 36 years of growth. At a doubling rate of once every 9 years, you get exactly 4 doublings, since 4 times 9 equals 36. Here's how that plays out. $100,000 grows to $200,000, then $400,000, then $800,000, then finally $1.6 million by your last day of work. Now slow that doubling rate down to once every 11.5 years, and only 3 doublings fit within that same 36-year window. your final total stops at $800,000. That missing fourth doubling represents the entire difference between the two outcomes. The encouraging part, though, is that this worst-case scenario reflects the harshest possible tax treatment, the kind that taxes your money every single year, similar to a savings account or profits from frequent trading. A simple index fund that you buy and hold rarely faces this issue, since you only owe taxes when you actually sell. So the more important question becomes, which type of account holds that index fund? Broadly speaking, there are two categories of accounts: a tax-sheltered option like a 401k or IRA where growth isn't taxed at all while it's invested, and a standard brokerage account that receives no such protection. Within the sheltered category, you then choose between two variations. Traditional, which gives you a tax break now and taxes withdrawals later, or Roth, which works in reverse, you pay taxes now using money you've already earned and then never pay taxes on it again. This is where a lot of financial content gets it wrong. If your tax rate stays identical between now and retirement, traditional and Roth accounts produce exactly the same outcome, dollar for dollar. Roth only becomes the better choice if you expect a higher tax rate in the future, or if you're already maxing out your contribution limit, since Roth dollars are already taxed and therefore represent more actual value within that same limit. The account that consistently underperforms is the plain brokerage account, because the IRS collects a portion every year and again whenever you sell. Over an entire career, this can end up costing an average saver well over $100,000 compared to keeping funds sheltered. So the priority order is straightforward: protect your money first and save the taxable account for last. So how do you actually keep more of your earnings? Here are 3 key moves. First, always claim your full 401k match. Many employers will match your 401k contributions dollar for dollar up to a certain percentage of your salary, typically somewhere between 3% and 6%. Let's say your employer matches up to 4% and you earn $60,000 annually. Contributing $2,400 a year gets you another $2,400 added automatically. That's an instant 100% return the moment the money hits your account, and there's nothing else in investing that reliably offers that kind of payoff. Second, maximize your tax-advantaged contribution space. In 2026, the IRS allows contributions of up to $24,500 into a 401k plus another $7,500 into an IRA, giving you $32,000 of space per person each year, where both growth rules apply at full strength with no tax drag whatsoever. Within that space, decide between Roth and traditional using the same principle mentioned earlier, based on where you expect your future tax rate to land. The priority order never changes: secure the match first, then max out this space, and only after that, consider a standard brokerage account. Third, understand the 0% tax bracket, because most people don't even realize it exists. In 2026, a single filer earning under $49,450 in taxable income, or a married couple earning under $98,900, pays 0 federal tax on long-term capital gains. Add the standard deduction on top of that, and a retired couple with no other income source can sell around $131,000 worth of investment profit in a single year and owe absolutely nothing to the IRS. This is publicly documented. IRS math hiding in plain sight, and it's the exact bracket that allows disciplined retirees to sell off their winning investments year after year without ever cutting a check to the government. So here's the complete picture. The rule of 72 and the rule of 114 reveal the slowest possible pace at which your money can double and triple, while consistent monthly contributions mean you'll actually beat both of these timelines for years. The frequency of your contributions barely matters, so automate the process and stop worrying about it. You're doing most of the work early on until you hit the crossover point. And interestingly, when contributing steadily at 8%, that point tends to arrive around year 10, whether you're investing $100 a month or $1,000. Starting earlier pushes that point sooner. Larger contributions push it later, and the type of account you choose ultimately determines how much of your biggest doubling you actually get to keep. Tonight, take a moment to run your own numbers, your monthly contribution, the years you have left, and the type of account your money sits in. Track your doublings and triplings after accounting for taxes. If this changed how you think about your money, consider liking, subscribing, and sharing it with someone still doing that old 18-year mental math. And here's something worth thinking about tonight. How many doublings stand between you and retirement? And who ends up owning that final one, you or the tax collector? This has been Mind Pump, where ideas turn into action and action shapes your future.